Good morning, everyone. At KBC Group, we recorded a net profit of 546 million euros in the first quarter of 2025. Compared to the result of previous quarter, our total income benefited from several factors, including increased insurance revenues, trading and fair value income, and net other income, while net interest income and net fee and commission income were slightly down as a result of seasonality and some positive year-end effects in the fourth quarter of 2024. Our loan portfolio continued to expand, increasing by 2% quarter-on-quarter and by 7% year-on-year. Customer deposits, excluding volatile short-term deposit at KBC Bank's foreign branches, were stable quarter-on-quarter. However, on a quarterly basis, we've noted a shift from term deposits to saving accounts. Year-on-year, our customer deposits were up 7%. Operating expenses were up, since the bulk of the bank and insurance taxes for the full year are, as usual, recorded in the first quarter. Disregarding bank and insurance taxes, operating expenses fell by 8% quarter-on-quarter. Insurance service expenses also fell, as did loan loss impairment charges, resulting respectively in a very low combined ratio of 86% for the insurance business and a very favorable credit cost ratio of just 8 basis points for this first quarter of 2025. Our solvency position remains strong, with an unfloored fully loaded common equity ratio under Basel IV of 14.5% at the end of March 2025. Our liquidity position remained very solid too, as illustrated by an LCR ratio of 157% and an NSFR ratio of 140%. On the 8th of May 2025, we paid a final dividend of 3.15 euros per share, bringing the total dividend for full year 2024 to 4.85 euros per share. Looking forward, we have updated both our dividend policy and our capital deployment policy. As far as the dividend policy is concerned, from 2025 onwards, the dividend payout ratio, including the payment of the AT1 coupon, will be between 50 and 65% of our consolidated result. An interim dividend of 1 euro per share will be paid in November of each accounting year as an advance on the total dividend. Regarding our capital deployment policy, KBC remains to be amongst the better capitalized financial institutions in Europe. Each year, when announcing the full year results, our board will take a decision at its discretion on the capital deployment. The focus will predominantly be on further organic growth alongside mergers and acquisitions. We see a 13% unfloored, fully loaded CET1 ratio as the minimum. In addition, KBC will make use of the AT1 and Tier 2 opportunities of the Pillar 2 requirements and will start using SRT instruments to optimize its capital base. Furthermore, KBC reached an agreement to acquire 98.45% of 365 Bank in Slovakia. This investment will allow us to further strengthen our position in the Slovak market while closing the gap with the top 3 players in the banking sector. 365 Bank is a retail-focused bank with subsidiaries in leasing, asset management and real estate services. They complement our business in our Slovakian subsidiary ČSOB, resulting in cost and cross-selling synergies. KBC will significantly enhance its presence in retail banking through access to the unique client base and distribution network of 365 Bank, as well as its exclusive partnership with Slovak Post. The closure of the deal is subject to regulatory approval and will reduce our unfloored, fully loaded CET1 ratio of KBC Group by approximately 50 basis points upon closing, which is expected by the end of this year. In recent weeks, there has been significant macroeconomic and trade uncertainty due to the US policy on trade tariffs and its impact on financial markets. Despite this, we affirm our short-term and long-term financial guidance in all aspects. Finally, I would like to thank our customers, employees, shareholders and all other stakeholders for their ongoing support of our group. We remain committed to being the reference in bank assurance, innovation and digitization in all our home markets.